As a real estate agent, this is one of the most important concepts that you need to understand because it is going to be the concept and the topic that strikes any conversation about real estate. This is what can separate you from performing and looking like an amateur agent versus looking like an agent who's very competent about the real estate business, and that is the real estate market. Just imagine you're in an elevator and someone asks you what you do because you're all dressed up and you look like you may do something very important, and they ask you what you do and you tell them, well, I'm a real estate agent. The first thing that they're going to ask you 9 times out of 10 is, oh, how's the market? And so that's why having knowledge of the market is one of the most important things that you want to have knowledge of, and you want to know it at the beginning, because this is how you can get some easy leads. This is how you can really distinguish yourself as a real estate agent, and people are going to think that you know what you're talking about, even if you don't. And so the market is described as the current state of movement of properties as it concerns real estate. And so you may have heard people say things like good market, bad market, it's the seller's market, it's a buyer's market. We're going to go through all of those, but those are common terms to describe the market. So being able to understand your market is very important to you as an agent because it will assist you with the evaluation of properties, the marketing of properties, having conversation, getting leads, just everything overall. And so we're going to really dive deep into the concept of the market. We're going to talk about the different types of markets, so that you can understand, even if you're just watching the news or reading some information, so that you can understand what all of that means and be able to articulate it to anybody else who may ask you, how's the market? So let's start with the different types of market. The first market that we're going to talk about is the seller's market. When you hear the term seller's market, it's a market that's in favor of people who want to sell their home. Okay? Basically, to know if you're in a seller's market or not is there are more buyers than homes for sale. So all of the buyers are trying to get some of what's available. Now, factors that we'll often see in a seller's market, or factors that affect a seller's market, are going to be things like high employment rates, low interest rates, or different bank regulations that are more in favorable of buyers. So if it's a high employment rate, a lot more people have jobs so they can afford homes. So a lot more people tend to go and buy homes. If the interest rates are low, that means a lot of people's payments are going to be lower. And so this tends to bring out a lot of buyers. Some of the advantages in a buyer's market is sellers can get more for their properties than they're actually worth. Just because there's a lot of competition there. And so another advantage sellers tend to see is multiple offers, because you have a lot of buyers competing for this one thing. It's kind of like if you were going into the grocery store and maybe if there was a storm coming and everybody was rushing to the grocery store to go and get water and food to maybe hold them over for a couple of days, and you get in there and there is a ton of people, but there's not as many jugs of water, or there's not as many loaves of bread. And so that tends to either drive the price up, or some people just can't get something because other people have gotten it. And so that's kind of the same thing with a seller's market. There's a lot of buyers out there to buy homes, but there's not a lot of homes for sale. So people are just kind of getting what they can. On the flip side of that, we have a buyer's market. So a buyer's market is a market that's in favor of the buyers. There are more homes for sale than there are actually buyers who want to buy. So the factors that affect a buyer's market are going to be the opposite. So a high unemployment rate. So if people are losing their jobs, or there's not a lot of jobs out there, that can put it in a buyer's market. Or the fear of interest rates. So just thinking that there's something about to happen, I don't necessarily want to buy right now because I'm not quite sure. Like, a lot of people tend to do this during an election time or election year because they just don't know what's going to happen. Now, some advantages of a buyer's market is buyers don't have to rush out and go purchase a home. So like in a seller's market, if something goes on the market today, it could potentially be gone in a couple of hours because there is a lot of buyers and they all get in and they all submit offers. Versus when it's a buyer's market, you don't necessarily have to rush like that because things will tend to stay on the market just a little while longer. After that, another advantage of a buyer's market is buyers have more options. So buyers can typically get what they really want versus let me just get this because this is all that's available. And then the last advantage of a buyer's market is prices are generally a little lower as sellers are more motivated. So more buyers can get a deal in a buyer's market, which is why it's called a buyer's market because it's in favor of the buyers. And so sellers will lower the price, and this can get even so crazy because especially in neighborhoods where there's multiple homes for sale, you'll just start to see like a trend. Like one will lower their price, then another one will lower their price, and another one will lower their price, and they keep going down because they want to be the first one to sell their home. And so those are the two common markets, the buyer's market and the seller's market. So if you hear those terms, that's basically what that means. Something to keep in mind: as an agent, you don't control the market. So when you're discussing the market, you're basically turning into an advisor of real estate. You simply advise on the current state of the market. I hear a lot of people who make market predictions and projections and all kinds of stuff in hopes of getting someone to buy or getting someone to sell. And this is not smart. It's not smart. None of us are psychics to predict what's truly going to happen at any given time in the real estate market. All you want to do is present the facts, figures, statistics, numbers, all of that stuff so that your clients can understand what's going on in the market and not necessarily you telling them where the market is going or where it's heading in hopes of getting them to perform whatever real estate transaction. Now, the next thing I want to go into now is bull and bear markets. And this is a common term used when describing the stock market, but it's also very applicable to the real estate, especially since the stock market generally affects the interest rates, which affect your buyers and your sellers. And at the end of the day, is going to determine if we're headed into a buyer's market or a seller's market. So the reason why this is important to present to you in understanding markets is you can simply kind of see what's going on in the stock market to determine what can kind of happen in the real estate market, or can determine where the real estate market is headed. Now, keep in mind, history always repeats itself. We're not going to always be in a great booming real estate market. There's going to be bubbles, there's going to be crashes, and that's just going to happen. But there's ways that you can still conduct business in the midst of whatever's going on. Now, the terms bull and bear are used to describe the current state of the stock market. So you're most of the times going to hear this when you hear people talking about stocks, or if you're watching MSNBC or whatever, anything like that. And basically what it just determines is if the stock market is appreciating or depreciating in value. So if the stocks are going up or if they're going down. So the term bull market refers to a market that is generally on the rise. So it's going up. You're going to look at a graph and you're going to see it curving up. And people tend to speculate that that trend will continue upward. Now, during this time, the economy tends to be in a good shape. Employment's high, everything's going good, people are buying houses, people are, everything's good. Now, in contrast to that, the bear market is the total opposite. So things are on a downward trend. Share prices are dropping. During this time, unemployment increases and people start laying off their workers. It's not a really good time economic wise. Now, here's what these two things do for real estate though, because they kind of do the opposite for real estate that you would think would happen. During a bull market, meaning that market's going up and it's on an upward trend, the interest rates tend to be higher. Because things are good and people can make more money, people are spending more money, so we tend to see higher interest rates. Now, in a bear market, when things are going down, then interest rates tend to lower. So it's a good time for buyers to buy, and the reason this is happening is because they're trying to strengthen the economy more. So if we can get more buyers coming in, and if we can get more people buying houses by offering them lower interest rates, that's what we're gonna do. So this is a good way that you can kind of predict your housing market and be able to explain it to your clients. Now, there are different markets out there, and depending on what's kind of going on in the stock market with unemployment, that can kind of tell you the real estate market. I know that we've been talking more so about numbers and trends and the global economy, but when we go into actual real estate markets that you as an agent are going to be working in, these are what's going to divide your activities, or what's going to show you what people are doing, what people are buying, what types of products people are interested in. Okay, and so the different types of markets that I want to focus on are in let me just say one thing: these are not to be used in determining value. Okay, the different type of markets are going to be your rental market, they're going to be your luxury market, they're going to be your new construction market, and then your first time home buyer markets. Okay, these are all of your local markets. Now, the reason why I didn't say things like condo market or just normal single family home market is because those are the markets that kind of fall in the middle. They're pretty much located everywhere. There's a lot of them, but when we're talking about rentals, luxury, new construction, or first time home buyers, those tend to be four different types of buyers that are largely affected by how the economy is. And so the way that you can kind of really study your market is very crucial to your job as a real estate agent. And I really want you to practice this, because especially if you're going to want to work in the luxury market in the future, people really rely on your market knowledge. And when you're talking to luxury clients, that's all they pretty much want to talk about. They don't necessarily want to talk about the flooring. I mean, all of those conversations are going to come up, and it's not all about these chandeliers, but it's really about the different markets. Okay, they want to know if what they're investing in is going to give them a return, or if it's going to be a bust. And so a way to study your market are going to be the homes listed, the homes sold, the average days on market, and then the list price versus sales price. All right. So just as an example, if I was doing a market analysis and I see that there was 7 homes listed within the last month, and I saw that 7 homes sales sold, that's a good market right there. You know, and even going further, I see that the average days on market is maybe 2 days. Okay, you can already see that we're in a seller's market just by those three facts. The fact that every home that was listed was sold, and it was sold within 2 days, is showing that a seller's market. And then lastly is list price versus sales price. So let's say that the list price versus sales price was at 102%. That means the sellers got more for their property than it was actually listed at. And so that's a good seller's market right there. Now, depending on what niche of real estate you work in, business can be a lot better or it can be a lot less, as determined by the actual market. And so just think about this. If the market was to crash, there are certain markets that would get hit super hard. The luxury market. The luxury market would definitely go down. And so any agent who's solely working in a luxury market, it would not be the most favorable market for them. New construction tends to go down because a lot of builders will stop construction projects, or the cost of materials would go up. And so that demand for that product would go down. Rentals tend to go up. And so a lot of people who may have to sell due to a market crash are going to now try to go and rent. And so we tend to see a surge in the rental market. And then also the first time home buyer eventually goes up with that too, because in an effort to stabilize the markets, the government most times will will roll out incentives and programs and all kinds of stuff to get people buying homes. And so we tend to see a lot going on with first time home buyers. Now, if we're in a good market, a lot of those markets are thriving. So rental rates tend to be at an all-time high. New construction can be a little iffy. Now with new construction, there tends to be a demand for a product, but once that there tends to be an oversupply of it once the builders start to get going. And so these things can happen as, like, let's just say a major corporation was going to be moving into your city, okay, and it's going to be bringing thousands and thousands of employees, maybe even multiple thousands. What that's going to do is a lot of builders are going to start building. They're going to start building, and they want to, make all this money because such and such is moving to this suburb of whatever town. So all these builders are going to start building. Eventually what's going to happen is there's going to be too much product, and they're thinking that all these people are going to go and buy their product, but that's not truly going to be the case. In a good market, the first time buyer market may not be at its best, simply because prices tend to be a lot higher, and there is a good amount of rental products out there that may fit their taste a lot better than what they can afford being a first time home buyer. And so that market may not be the best for when it's in that really good real estate market. There's a lot of competition, and there's higher home prices. Now, this was a full-on big level view of just the market in general, and I showed you different views. So I talked to you about the different types of markets. So we talked about the seller's market, we talked about the buyer's market, and then we got into the bull and bear markets. So understanding how the stock market can affect the real estate market, and then determining your different markets that you're potentially going to work in and how they can be affected by economic changes. And so on a high level, this can get you through any conversation regarding the markets, because you now have an understanding of how the actual markets work. From here, what you want to do now is focus on the markets that you're going to be working in, and that's where you're going to get into doing things like evaluating the homes listed, homes sold, the average days on market, and the list price versus sales price. And so what it would be a good idea for you to do is start to study a specific market. Now, don't do this as a whole. So for instance, I wouldn't study the city of Dallas as a whole, but you want to break it up into these pockets depending on what you want to work in. So if you want to work in the luxury markets in a certain area, then that's the market that you're going to study. If you want to work on the new construction market in a certain area, that's the market you want to study. You don't want to do it just big as a whole, but you want to get really micro with your markets that you are studying.